Good afternoon, everyone. This is Jason Ulrich with Top Shelf Traders. I hope you're all having a great day so far and a good close to your week. I can't believe it's already Thursday afternoon, and tomorrow is going to be December 1st, if you can believe it. Let's start with a quick sound and visual check. We've still got folks filtering into the room, but if you could do me a favor, just in the questions box, let me know that you can hear me okay and that you can see my screen okay. Perfect. Perfect. Actually, we're looking at Steve Vetteral's screen. Now, this session that we're hosting this afternoon is intentionally unlike any of the other ones that we've had so far. So, as many of you know, and I see a few regular faces here and names, people that come and attend our events, you know that we spend a lot of time talking about trading, different trading strategies, setups, etc. One of the regular questions that we get, though, especially with the ES doing what it did today and continuing to climb, we get a number of questions around, well, what happens when the bottom falls out, when there's a major correction? And this is a conversation that we've been having with Steve for quite some time, and so it resulted in our session today. We're excited to share it. Mitigating risk in a bull market. So everyone talks about diversification, but very few folks really actually have it, nor do they fully integrate it into their portfolio. So we're not going to necessarily talk about trade setups. We're certainly not going to be covering Fibonacci sequences or anything like that. What we're going to be doing is we're going to talk about the importance of having this risk mitigation in your portfolio. Now, Steve is someone that we've been in touch with for quite some time. We've had the privilege of publishing an ebook with him, and he's one of the constant regulars with Top Shelf. If his name sounds familiar, it's because he has a pretty large presence out there. And a number of clients that he works with, and a pretty big social media following as well. So Steve comes out of investment banking. He is a portfolio manager, and he's also a trader. And so we'll go ahead and dive right in. As always, these sessions are designed to be informal and interactive. So if you have questions, please go ahead, put them in the questions box. I'll go ahead and man the questions box, and then we'll get ourselves out of the gates here. So Steve, thanks for joining us. It's great to have you, and look forward to it.
Okay. Thank you very much, Jason, and the team at Top Shelf Traders. I'll tell you, it's really good to be dealing with such a quality organization. You guys really do get it, and it's good to see that you're trying to bring hopefully thought leaders like myself to the table to talk about stuff that really doesn't get chatted about much. Let me just make sure everybody's okay. Sound check on seeing my screen, hearing me okay. I have a microphone that's new, so if it needs adjustments in recording, just let me know. I can always turn the volume up. But in any case, just housekeeping, if I may. We will do a recording of this, and once the production's finished, and we'll also offer the slides to today's presentation as well. You can get the slides. We'll show you how towards the end how to do that. It's important in any of my presentations that if you have questions, please type them in the box as we go along. I really try to make time towards the end to answer questions. I'd encourage you also to focus on the slides and maybe sort of turn off phones, any other distractions that you have, because I'm going to present some information that I've never put in a webinar before. And this webinar has really just been a culmination, if you will, of many different types of webinars that I've done, mostly in a live audience format in the past, with both Benchmark and the previous firms that I've worked for. So I've sort of tried to hone this down, make it very basic and broad. We certainly can spend many hours doing a deep dive into a lot of specific subjects related to portfolio management. But our goal in this webinar series is to kind of hopefully start like a TED type talks in the financial field. And we really like to, the first topic essentially be what investors rarely hear about in the real story of allocations and risk and mitigating risk and portfolio construction. So this topic of downside protection, if you will, is probably one of the most requested of the webinars that I've ever done for any of the previous firms today. So I thought it'd be good to catch it on, and hopefully Jason's got us in a nice high definition recording setup. So I'm going to present some stuff, and maybe a little tough to see, but hopefully we can get that around. So if you guys stick around at the end, I have a bonus PDF if time allows. It's 18 questions to ask your broker or investment advisor, something we share with clients that really touches along a lot of the points I'm going to go through today. But just let's get into this. We've got about 20 slides to cover. It's not a lot, but just a little bit about me. I was fortunate enough to win the Investopedia Award a little earlier this year, one of the more influential advisors in the country. That was some cool stuff. But the bottom line is, started in the industry in '97, was hired by Fidelity in '96, progressed into portfolio management and trading into 1998. I have many years of experience in trading all kinds of different stuff, both credit and equity sides of the industry. Portfolio analysis, so forth. But my real break came at Fidelity when I was asked to trade for a lot of the large portfolios at Fidelity. A lot of the portfolio managers, so forth. Peter Lynch, who was retired at the time, and I really got to see when I was trading those personal accounts. And obviously, confidentiality was just of utmost importance back then. But man, the whole buy and hold thing was just absolutely dispelled, spending a number of months on that trading desk. And I came away with the feeling that, geez, the whole industry is just brainwashing people out there into buy and hold because they want to be asset accumulators and not try and make strategic, sort of macro or high level changes, or the tactical or more of the fine-tuned changes to portfolios to as we complete full market cycles. And I saw this just take place in spades, and it really sort of soured me on that side of the industry. So at the time, I was being recruited away from Fidelity by Ken Fisher. He wanted me to represent the firm in an RVP role in the Mid-Atlantic, and I was fortunate enough to sort of study alongside with him, and it really opened my eyes to strategic and sort of modern portfolio theory, and many individuals that have contributed to that have shaped financial theory, and the Nobel Prizes that have been awarded along that way to sort of form a capital market science that I spend a lot of time working on. But the beauty is that as my role, which is mostly spent managing client portfolios, I do a little bit of work on our sister company side at FXE as Trader, but really the key is the research is all out there. I mean, I'm not trying to reinvent the wheel. I'm using what has won multiple awards. I'm using that type of science to put together and structure portfolios to weather any storm and make changes to that. So I have a fairly large following in social media. At my Twitter handle is @FXESTrader, if you care to follow me. The webinars I've done from multiple organizations out there, both brokerage and software companies, has mostly been on the trading side of the business. So let's go over a quick overview of what we're going to talk about today. You guys already got probably a bazillion emails on this, but essentially my hope is that you learn why portfolio diversification matters, but that strategic shifts are what drive real performance, and the tactical shifts as well, especially if the portfolio is generating income. So buy and hold investing doesn't work if you need the portfolio to generate income. We're going to go through over the next 3 slides just a quick review up until the end of September of the past returns of the S&P 500. Lots of different equity markets. S&P 500 is a capitalized weighted index. It is much more broad as far as covering 500 companies that trade publicly on the different types of exchanges here domestically in the U.S. But I think what hopefully will inform you, maybe even a little surprise you, is some of the slides we'll talk about on how the markets have performed and how that impact has trying to at least stay away from some of those corrections over a greater period of time. And then we'll end it up by talking about just briefly about high versus low beta stocks and dispelling some of the 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 brainwashing, I guess, if you will, of the market on that. And then really finally, the one of the other important things my takeaway for everybody is today is that you can actually redirect towards your investment advisor a lot of these types of questions. And the important point also to understand is that what I'm about to talk about also is going to require a certain amount of open-mindedness. So if you can please put aside any biases you have. We're not here to talk about the market crashing or it rallying as much as it has. I mean, what we're really here to talk about is how to correctly structure a portfolio diversification-wise, but also understanding how institutional investors act and structure portfolios differently to mitigate risk, sort of helping you be able to weather any water. But the changes that those portfolios require to weather a lot of those choppy waters does require a certain amount of skill by the investment advisor or portfolio manager to be able to make those changes. And the more nimble the firm is for their clients to be able to make these changes, the better off you are. Because I can tell you from past experience, I joined two organizations, one which is the largest in this country, I guess arguably against Vanguard, right? And another organization that was very nimble, that had the ability to do these types of things in the early days of the 2000s, but as the firm grew in size to a behemoth that it is today, they are not nimble anymore. And I think this is probably one of the biggest problems in the asset management industry that most of the asset industry and all their minions will never talk about. Because they'll just say, oh, well, that's market timing, and you can't time the markets, and all of that. And the important thing is that what there's a pretty big handful of people on this planet that have successfully timed the market. I doubt any of these individuals, he or she, has caught the top or bottom of the market. But the important point is that they've cut a swath out of those returns, especially the negative ones. And most of those individuals adorn the top of the financial lists from Forbes, right? Some of the richest people in the world in finance that haven't inherited their money, that have started off as early traders, honed their skills, became exceptionally good at what they did. Guys like Paul Tudor Jones, Steve Cohen, Julian Robertson, I mean, the list goes on, that built monster firms. In many cases, these were hedge funds and alternative firms that were successful at this. So you kind of have two sides of the industry. You have the industry that mostly caters to retail, that is sort of buy and hold and put a good diversification together. And I think that's important, have low-cost investments, and of the ones that aren't index-based, make sure they can outperform their respective benchmarks from an active management side. And then you have the institutional side of this business that has a much broader spectrum of their investment diversification. They invest in alternatives. They invest in the different types of alternatives like hedge funds, private equity, venture capital, and all the different strategies, including real estate, that underlie many of those main areas. There's tons of them out there. So I'm going to show you an allocation once we get past some of our slides to get current with where the market is in terms of ups and downs, and you'll begin to see kind of how the allocations look for an institutional investor. So let's start with the first slide. Keep in mind, everything is set as September 30th. I know we've had some pretty big market moves since then, but let's just take a look at first slide of what's happened since 1997 in the S&P 500. And really not as important that you get caught up with a lot of the fine print, is just focusing on the moves that took place as we were in the tech boom, as on the left side of the chart here. And I always try and grab a tool with this stuff, Jason, but these tools always seem to just not work very well. But let me just try the highlighter here. So our first move up, you guys can see this yellow cursor. we had a pretty good rally, and a lot of people were caught up in tech stocks and the beginning of the internet boom and all kinds of stuff, Pats.com, the list goes on. I was very fortunate in this period of time to have invested in a lot of tech stocks, primarily Dell Computer, which was a real ongoing concern business in my opinion at the time. It did quite well for me and sort of started my career off from poor college kid into his first years in finance. Also bought my first townhouse. But the performance in here was really based on a lot of falsification, and the individuals that caught it right really were taking a lot of risk off the market in the beginning quarter of 2000. Obviously, we had the NASDAQ crashing much more than this S&P 500 chart here. And then subsequent rally, almost the same in terms of the move back up that we had in the latter part of 97. And we had obviously another crash. This was the financial crisis. So what's important about these first three, and I guess you could argue even four moves, up, down, is that if you are an investor that has a portfolio, whatever the size of the portfolio, whatever diversification was, if you were heavy in equities and you did not take some off the table, you took some pretty crushing losses. In the case of some of the investors that had a portfolio when they needed to generate income from, not only were they getting crushed in the equity portion of the portfolio, but they were also just taking income out of the portfolio. I mean, that is a double negative is what I like to call it. In a lot of cases, that evaporated a huge chunk of the portfolio, okay? Now, obviously, most in the industry will look at this and say, well, markets go up 2/3 of the time and down 1/3 of the time, and yeah, that's true, but if, your focus is long-term, you want to buy and hold and stick with it. And, I mean, it's a good brainwash, if you will, for a lot of the retail investors, but in all actuality, a lot of investors, they sold at the bottom down here, and then they started buying again at the top. I mean, the average investor's return, and there's lots of different sources out there, but the average investor's long-term return is like around 3 or 4% because they're always making the wrong adjustments at the wrong time. And most of it's based on emotion, not rooted in any sort of financial theory or a plan. So the important thing to understand is, nobody really is smart enough to catch tops or bottoms, but from a technical analysis perspective, there are a lot of things that is showing up when a market's topping. A lot of that stuff, unfortunately, we're seeing today. So, but the problem with topping and trying to call tops or bottoms is that the market can be irrational a heck of a lot longer than you can be solvent. So you really want to see a top or bottom take place first and then act upon it. And they aren't dramatic actions that should be taken. But if you lightened up an equity portfolio 50% off the table, it still can help you mitigate a lot of risk on the way down. Same thing on the way up. If you're very heavy in cash or credit or some sort of alternative strategy and you think equities are going to rally a bunch, you may not be catching the bottom, but there are certain signals that we've sort of crossed major resistance points, and volume is poured in after that. And I don't want to get too deep in technical analysis, but there's all kinds of sophisticated indicators that show that. It's just a matter of knowing how to read them. But at the end of the day, the most important indicators are Tom DeMark's indicators and a lot of sentiment indicators besides just volume pockets and support and resistance lines. So you can understand with auction market theory the correlation between all those, and sort of come to a conclusion. It's actually not that difficult to see that, hey, we may be rallying. We may not know how much longer we're going to be rallying or dropping, but there are signs for that. So one that is skilled in portfolio management and has been through many market cycles as I have, it is something that can be accomplished. So our what I usually will tell prospective clients is, we're looking to at least avoid 50 to 60% of the decline, because we're not going to catch tops or bottoms either. We're not that good. So what else should be of note here? And obviously towards the right side of this chart, the huge rally that we have seen since 2009, and there is so many reasons for this rally. I mean, the primary reason is the global central banks have been dropping what I like to call money out of helicopters for a long period of time, that have just recently started to curtail what's called their quantitative easing. So, but just increased the supply of money globally, and it really has just absolutely poured into most developed equity markets, and some commodities, with the exception of oil. So the next slide is one that may seem a bit confusing. Actually, you know what? Let's start with this one first. What I really want to illustrate with this slide is if you look at the top part on the left, you can see the dates as they progress from 1926 to now. This is the whole history of the S&P 500, by the way. And it goes through with each of these blue numbers starting 1 through 10. It goes through each decline, and it shows the magnitude of each of the declines. Obviously, the biggest magnitude was number 1. That was the crash of 29. That's where the S&P dropped 86% over a 32-month duration. And corresponding, the magnitude of these declines is right around 20% on average, but there's been some real doozies, including in number 10, the global financial crisis. So I always say to somebody, always put yourself in that position. Picture yourself as that retiree from whatever company or your business or your profession, your occupation, and you have $1 million portfolio, and you've got, I don't know, maybe you need $40,000 a year in income out of it. This is a typical client of Benchmark, and they need to generate that type of income through a variety of income generating sources, and mostly credit-based or bond-based, or loan-based, or fixed income-based allocations. But and the other 60% is in equities, right? You've lost essentially half of the value of that equity portion of the portfolio. So that means the portfolio is down about 300 grand, and you still need $40,000 out of that portfolio that particular year. So we like to set up a strategy with clients where we put what's called a top and bottom guardrail. This is a piece of research that, in my opinion, really should be up for a Nobel Prize. That was written by Wade Pfau on setting up guardrails to protect portfolio volatility, and it sort of dovetails in with mitigating risk. But the important thing is that understanding the magnitudes of these declines and the durations of them. You can have an average duration, but typical duration is about 12 months. So you can almost have 2 complete years of an income cycle drawing out of a portfolio, and the equity portions getting hit. That could have an absolutely catastrophic event on a portfolio. So, you with most of the webinars that I see presented by investment advisors out there, they don't bring any of this stuff up. So I'm maybe taking a little bit of a dire approach to this, but I think it's more important to understand how this can affect a portfolio. And again, we'll present the slides to this if you guys want to see them. I'll just convert them into a PDF file. We can send them out. But that's pretty much all I want to talk about in that slide. Let's go to intra-year declines. Sort of says it's the same topic. This is from 1980 on to September 30th again, going through the declines in the S&P and what the intra or the worst of the decline was that year. So you can see the average decline, but some of the worst moves down took place, and obviously of recent haven't had much in the way of corrections, making this a little more of a teetering type of rally. And I understand that the markets are reading into this tax reform in the U.S., repatriation of trillions of dollars of corporate income, and lower corporate income tax rates, lowering them. I mean, it's a positive thing the market's viewing if Washington can actually get this bill done, and it doesn't look like a piece of crap when it comes out of committee. then I think that maybe there's some ground to stand on after we have a pretty good correction. That's just my view. I could be wrong. So with the next slide, probably be something that everybody's seen if you meet with your investment advisor on a regular basis. It's probably one of the more popular pieces that's put out there. This is the Cowen Periodic Table of Investment Class Returns. This is showing all of the indices, whether it be a global index, an emerging market, different types of both value or growth indices, tech-heavy indices, so forth. This is not a sector analysis. This is just showing the indices ranked by performance. All we want to glean from this is that everything's all over the place. And this is the argument for diversification. And honestly with you, I agree. If I was to show you the periodic table of alternative asset class returns, it will look just like this. You'll have periods where, just like you see here up, you see my yellow cursor, where emerging markets dominated the top performance for many years, and then they got clobbered and they were at the bottom, right? Whereas if you look at the alts returns, alternatives, you'd see that a lot of the private equity, essentially buyout funds, they dominated a good chunk of the list towards the top. I didn't put that slide in because I don't want everybody to get confused on it. This is just, the point is you want to be diversified. My only argument to take it beyond what the retail side, the street wants clients to be invested is, I also want clients to be invested in some alternatives as well. And that helps mitigate risk. That helps avoid big downs and be more of a general, more of an institutional, broad-based diversification. So really the only other thing to take away from this is if you look at the S&P, it's in almost what is that, like an army green, if you will. You can see its performance through the tech bubble into 2000. So notice the S&P had declines of 10%, 12, and then 22% into 2002. So that's over a 40% drop in what is a primarily large cap stock fund. Some funds did better, the index did that. And then your more volatile stuff like emerging markets, which is actually having an outstanding year this year in 2017, didn't do as great in 16, and then has had many years where it's just gotten shellacked and been at the bottom of the list. But there's still an argument for being diversified in all of these areas. Managers that are quality have been at the helm for some time. As you'll see, I'm going to show some examples of those types of managers that we utilize for clients. And in almost all cases, these managers, the organizations, have won multiple awards. They've shaped financial theory, and they think much differently than just buying a bunch of index funds. So with the next slide, this is just all of the fine print, and all this explains the different indices and so forth. You guys can go through that on your own. So let's talk about what's important here. Let's talk about why diversification is important to portfolio construction. Let's also get a little deeper into why I don't necessarily believe in buy and hold. The gentlemen you see on the screen have all made major contributions to financial theory, some more recent than others. There are 3 Nobel Prize winners on this list, and 2 of them, Eugene Fama and Cliff Asness, actually run respective firms that are very well respected among the investment advisors like myself, DFA's Dimensional Fund Advisors out of Santa Monica, and AQR up in Connecticut. So AQR is more of a alternative firm. They were a very successful hedge fund of a more quantitative nature. It stands for Applied Quantitative Research, that moved into running pools as if they were in an alt or a hedge-based strategy. A lot of their stuff is quant-based. Much of their funds' performance is completely uncorrelated with the performance of the broad equity markets globally. They do different things, especially mitigating lots of risk. One beautiful thing about both of these firms, and we've got several others that fit into this, is that they run very low-cost funds. You know, cost is important, and it's one of the core themes you'll see in the process of putting together a portfolio. It's important to find low-cost funds that have, especially if they're active managers, that have outperformed their respective benchmarks and generated what's called alpha. Alpha is nothing more than the performance of an investment or an investment pool above and beyond a given benchmark. So as an example, you have S&P 500 we've been talking about mostly today. You know, the index has a performance of 10% in a given year, and the fund does 12%. So they've generated 2% alpha above and beyond the benchmark. But the individual investor or institutional investor, they think differently. And my hope is that some of the webinars we do on this, I'm going to change that. I want retail investors to think like institutional investors. So how would that look? Okay. Now this is an example in the next slide of an alternative investment portfolio that is the Yale Endowment. This slide's a few years old, which is not that important. If you go to Yale Endowment's page on the website now, you can see an update of it, but I like this particular chart. This is an extreme example, but it's not an outlier in that a lot of the private endowments out there, a lot less you'll see of this type of allocation in a CalPERS or a CalSTRS or any type of public investment. But a lot of the private endowments, they have a much different allocation than the average retail investor. Well, the answer is, you know, the average person would look at this and say, well, why? I mean, they only have an allocation of 6% to stocks in the U.S. Yes, this is an extreme example, but they have the ability to access investment managers of a much more broad and diverse nature in the alternative space. So as you can see, they have a pretty big allocation to absolute return strategies, which is nothing more than hedge funds that are uncorrelated to the markets. They have the ability to long and short whatever in both the equity and credit markets. And there's a bazillion strategies in each one of these, especially in the hedge fund space, but there's plenty of different strategies in private equity. I mean, generally it's just a concept of buying out a firm or a business that's failing, or essentially, but there's a lot of these types of funds that really have a go anywhere mandate, and they can invest in almost anything, really just essentially trying to generate alpha, right? So the takeaway from this is that yes, equities have performed much better in the last 4 years than was the ending of this comparison, right? And we're only looking at a 10-year swath. But if you look back 20 or 30 years, those numbers actually stretch out. Yale's done an exceptional job of outperforming with much less risk than the broad markets. This portfolio doesn't have anywhere near the volatility that the S&P 500 would have. Or if you want to broaden that out, a Wilshire 5000, which essentially includes the top 5,000 capitalized companies domestically here in the U.S. So when I first saw this was quite a while back. I mean, it was shocking. Now, yes, Yale's out there, so is Harvard, and you know, there's a number of global endowments, and heck, for that matter, sovereign wealth funds that take a more extreme. But when you see their volatility numbers as measured by bazillions of different metrics, mostly just standard deviation is what the average investor understands, but there's all kinds of other ratios, Trentino, Sorrentino, so forth. that measure risk. But the important thing to just grasp from a broad perspective is that there's a lot less risk and they're far more diversified. So as an individual sitting there listening to this presentation, or some of the ones I've done in the past, the live audiences, I almost always got the question, okay, well, this is great, Steve. So how do I build this type of portfolio? Or how can I convince my advisor or whoever I'm working with to build this type of portfolio? And very simply, the answer is you go out. There is an absolute bazillion investment products. There's well over 900 ETFs, and there are a bunch of ETFs that do much of what you see. Not all of it, but But the problem is that how do you find the ETFs? And certainly, there's tons of algo-based analysis that can help you cut the learning curve and all that. But it is quite a daunting task to sift through all this. But essentially, in a broad, institutionally based portfolio, you're going to want to have exposure to some sort of bonds and cash, right? Depending on how much income you need, if any, or the term for those pockets of money. You're going to want to have exposure to stocks of both a global and domestic nature of all sizes, right? Now notice I'm talking about emerging markets. I have no comment, nor do I have any research to back up one way or the other, investing in what I like to call log cabin markets, where it's the Wild West, right? Kind of like Bitcoin right now. So, the international and natural resources, maybe not as much now, certainly real estate, and then the alternative space, all the different types of strategies in alternatives. I've talked about a few. I mean, ideally, the percentages will look different than what you see here, but this is really all the areas that should be covered. So with the next slide, let's talk a little bit about, I always title this the power of downside protection. So I've talked a little about the 10 worst versus the 10 best and how that makes a big difference. This is as of 2014, but it looks back 20 years, and it takes out some of the days I showed you in the previous slide, and it puts back in some of the best days, and it comes up with essentially the dark navy line is what the portfolio would be less the 10 best days, whereas all days is just the light blue, sky blue color here. And then if you took out the 10 worst days, notice the 10 worst days has had a much more dramatic effect by a lot than taking and making sure you're in the 10 best, which is what you usually hear from the street, your local folks, or all the knuckleheads on CNBC, because they're basically touting buy and hold, right? We can't time the markets. What they should be showing is this chart, because then a lot of individuals watching this will say, well, hey, wow, I need to try and find a way to avoid some of these worst days. So the far greater effect's important. Keep in mind, this graph's really just for demonstration. It's not meant to demonstrate whether benchmark was positioned in the S&P or sitting in cash or half and half or whatever. And all the disclosures on everything I've talked about is on the last slide of this presentation. So moving on, what else do I want to note on this? Yeah, it's a bit redundant if I keep talking about stuff the previous slide showed. So let's talk about the importance of being able to regain large losses. So outsized impact of the downturn, essentially the 10 worst days, is why I'm placing an importance on constructing a portfolio to weather downside protection. So really all this chart shows you is that if you have a 40% loss, you have to get a 60%, 67% return just to get back to zero. And if you have a 50% loss, as you can see below, you got to get 100% on that loss just to get back to flat. Okay? It puts a heavy amount of risk in the portfolio of ones trying to swing for the fence again, right? Trying to get back all of those losses. Okay, you saw just an inordinate amount of people that came to the previous firms I worked for at the time. A lot of this was going on in both the top in 2002 and 2007, coming with just large chunks of either the public traded stock for the company they work for, or with a very low cost basis. And they would always say, well, I don't want to sell. I'm going to have to pay taxes on this, whether it be a short or long-term gain, whatever the rate was, and all that. And most of them was just a 15% gain on the vast majority of that. But they didn't want to sell because they didn't want to pay any tax. And I would always make the argument, if you don't want to sell and you don't plan on paying any tax, you want to at least lighten up on this very heavy individual equity allocation, then let's collar it, okay? So again, something the industry doesn't talk about. Collaring. It's really no different than you taking your, make up the name of the car, right? Taking your $100,000 BMW and insuring it for a couple $1,000s a year so that if you crash the car, it's paid for. It's the same concept. You take a $100,000 stock position in whatever stock, as long as it has actively traded options on it, and you buy some protective puts, or you sell or write some contracts, or set up a straddle or a condor to protect the position over a period of time. And yes, there's a chance that you spent money on an option strategy that expired worthless, but the stock was protected over that period of time that the contract was in existence. So, I mean, again, a little tougher things to execute by the average sales guy selling annuities on the corner at Edward Jones, right? So important to think about how that would affect it. Ideally, in that case, you would have taken a good chunk off the table sometime after the peak in 2002 or 09, or heck, maybe even now, taking a chunk off the table. Yes, you're going to pay some taxes, but that's about mitigating risk, especially if you have a highly concentrated equity position in your portfolio. All right, so let's put it in just a more general form here, if I may. And really the goal, reduce the risk of unexpected large losses. So really this aim is to preserve more capital during stress periods in equity markets. You want to seek to limit drawdowns in portfolio value, access a wider spectrum of assets and strategies to achieve long-term growth. Looks like I got a typo in there too. Hey, April, you're fired. Just kidding. But and correct the risk imbalances of traditional diversification. So most diversified portfolios are still dominated by equity risk. So think about all of the universe of just stocks for the minute now. And you're in 2008, and everybody's like, oh, well, you're diversified. Now, your diversification failed, especially if you were drawing money out of the portfolio or just didn't have the stomach for 30 to 50% losses, depending on the type of equity pool. Okay, so those strategies didn't share any uncorrelated. They had a single point of failure in the crisis. Okay, so you want to create an alternate to having less reliable, higher cost strategies by ensuring some sort of, trying to get away from the market, buying insurance options like I talked about, or you could just sit in cash or have part of the portfolio in cash. I mean, these 3 bullet points at the bottom are not something you want to do with the entire portfolio. The market timing part can be quite difficult if you don't understand technical analysis. So that's the approach. Let's go into the protection strategy. So we're minimizing the impact of downside events. That's our goal. You're going to design it to protect against severe market drops and dampen extreme market volatility. So the sophisticated use of protective hedging strategies, master limited partnerships, nothing more than just long-term leases on oil and gas pipelines. They're very undervalued right now. Yes, they have gotten clobbered along with oil as a commodity and the crushing it's taken since it peaked out many years back. They offer good income opportunities, low beta, managed futures, something that I excel in before I started Benchmark as a trader. But the key is really in the different types of strategies, sifting through all of the options out there in both active and index fund and ETF fund land, and try and find a portfolio that's low cost that can be put together to go through these periods of time, but with the single difference that you're going to want to make nothing dramatic, but you're going to want to make some pretty good strategic and tactical changes to this portfolio and some of the allocations in the different areas we talked about as you're moving through a bull and bear market cycle. All right. The low beta thing's a pretty simple story. This is something that dispels most of what the street talks about. But a lot of the lower beta, essentially less risky, less volatile. So contrary to conventional thinking, high beta stocks generate lower returns over time than low beta stocks. There's actually a piece that was written about this. Is a phenomenal piece of research by Dr. Eugene Fama of DFA and Booth School of University of Chicago that actually details that he was one of the first people to come out with this type of study. Came out many, many years ago, but it really just sort of shot a lot of the conventional thinking apart on this. And that, heck, if you look at a long period of time, for anybody that is genuinely interested, it's very, how should I put it, put you to sleep type research, but it's good if anybody has a genuine interest in delving into this for a deeper dive. Almost all of these pieces are available on both AQR and DFA's websites. And if anybody has any questions, I can certainly show that. And actually, before I forget, if you would please, Jason, can you type in my website address? Actually, maybe.
Of course, I'll do it right now. No problem.
Yeah, well, before I forget, because I'm already getting a couple emails in asking some questions through my email.
You got it. Okay.
All right. What else do I want to talk about on this piece? I'm not really interested in getting too deep on this subject. We're already up against 50 minutes that I've been talking here, and I want to have some time to take some questions as well. So let me, I think, and actually while I'm on the subject, yeah, I don't want to get down that path right now. It's another 10 minutes easily. So why don't I just switch over to what's important here, jump forward to this one slide. So what does investment accumulation or wealth management, what's that approach look like in the long term? So in the beginning, you have an accumulation phase. Hopefully the managers you're working with have the ability to make some adjustments in the portfolio. It can get you more of a broader institutional type allocation. Moving into a preservation phase, obviously you may be moving the portfolio more away from an equity exposure to more defensive strategies or even income, depending, and then obviously the distribution phase. So this is the way that we view it. The suite of strategies that we offer to clients. I've mentioned DFA and AQR. We use a number of other managers. The clients can invest with these firms via an approved and investment advisor firm like us. We use the InvestNet platform. My whole firm is completely fintech. It's all technology run, so it really is a well-oiled machine of technology. But the important thing also to understand is that the average investor cannot get access to a lot of these managers. So at AQR, the only way you can invest with DFA and AQR is through an advisor-approved portfolio that's set up at whatever firm. In our case, we use Pershing, but TD Ameritrade, Fidelity, Schwab, all their institutional sides the advisors have. if they have approval, they can get access to invest clients with some of these managers. But what else do I want to say in this? So, yeah, I guess that's pretty much it. So my email address is steve@benchmarkadvisor.com.
I'll put that in too, Steve, here.
Yeah, because inevitably you have individuals that want to ask questions and so forth. But why don't I just open up the for any questions we may have. Well, one of the questions that came in my email quite a while back is what percentage right now would you put in all of these areas? And while I appreciate that question, I can't answer that. I've given the areas because I don't know these individuals' type of situations, and everybody's situation is different. I can't answer that. I mean, I can tell you that at least from an equity side, and I certainly could be wrong, and the market could run more, and frankly, I don't even care because we are very, very overstretched in equities. I absolutely would be taking some off the table. How much, and all depends on your portfolio. Any questions at all?
Any other questions coming in for Steve? Steve, one question that's coming in here, aren't a lot of the income-producing strategies or alternative strategies really illiquid? See alternative investments there. Is that one of the sacrifices that you have to make for diversification?
Not if you're invested with AQR or DFA. There's actually 3 other firms on that list. But no, they're instantly liquid. AQR operates as a mutual fund company, but utilizing hedging-based strategies. There is a lot of misconceptions in the credit side of the markets, and by credit I mean fixed income, in that the only way to generate income is to just put a certain portion in fixed income and let it peel off income in the form of a monthly or a quarterly dividend. That's the conventional thinking. There's actually a lot more ways to accomplish that. There's more strategies. There are many products out there, especially in the loan side or the real estate side of the market, and even high preferred dividend stocks that have very low volatility, even in some of the horrible periods of time I showed, that are spinning off some great dividends. So I don't think that an investor should just focus on, treasuries, corporate bonds, or municipals for income. There are other types of investments that can spin that off. And the beauty of some of the ETFs that we utilize is that they're as liquid as just executing a trade on whatever trading platform you're on, and you're out instantly. We're in.
Another question that's coming in, how would I even begin to evaluate whether or not my advisor or my team has downside risk mitigation of any side?
I have a list of 18 questions to ask your investment advisor.
Okay.
And, as I tell everybody with a lot of my other webinars, I don't expect everybody on this to watch this webinar. I don't expect everybody to grasp all these concepts in a first go-around. Watch the webinar again. Heck, watch it 5 times if that's what it takes. The important thing is the grasping of the broad concepts here. And then certainly if you want us to do a deeper dive, I can, guys, just send me an email and I will forward that PDF file to you. And just be prepared to have some completely glazed over looks from your advisory firm when you start asking some of these questions. And I can't tell you how many client meetings I've gone into with our current firm's clients and past clients, and we'll tell them to start asking these types of questions, and they'll be like, Are you crazy? You can't time the markets, and they'll just look at people like they got 6 heads, right? And so, I mean, that's why I always suggest in these types of webinars, and obviously I take a much more brash view on the industry because I was brought up, if you will. I was raised in the industry as a little young pup in the financial markets, to think that buy and hold was the way to go. And then when I really spent a lot of time researching, the most successful investors outside of Warren Buffett that were traders, they were awesome traders and portfolio managers way before they started investment firms. So, somebody that wants to do this themselves, I tell them, go out and become a great trader first if you want to build a world-class investment firm. But yes, to answer the question, there are a lot of hedge funds and private equity funds that have significant lockup periods. So we were one of the few when I started our Amenti Capital Firm, which is just a small long-short fund in '06. We only had a lockup period of 6 months. But, as a smaller fund, which we were at the time, we have that kind of flexibility. Once you become a larger fund, you start taking in more institutional investors, you have to put a certain amount of lockups on because, especially today, you have a lot of flaky money in institutional investors. And flaky meaning flighty, that they have a tendency to want to run. It's actually a big reason that AQR and DFA will not allow an individual investor to buy their funds. And by the way, the average cost inside of both of those families' funds, especially DFA, is 50 basis points. I mean, it's like index fund cost for a much better type of active managed. And it's one of the reasons that DFA and AQR have grown so well. I have no affiliation with these guys, by the way. I just choose to invest with the best, not the lowest cost index fund.
Got it. Okay, cool. I think we're closing in on it here, Steve. Is there a link to that PDF, or should folks email you? How should they get in touch with you?
If they could send me an email, I'd prefer that.
Okay.
I don't have the PDF loaded up on any website or anything.
Okay, sounds good. Now, everyone, I've put both the link to Steve's website as well as his email in the main chat box. So go ahead and use that. And when we follow up with the emails, we've got a few folks that registered but weren't able to make it. We'll be posting and sending a link to the recording. So we look forward to having that, and we'll include Steve's information on that as well as anything else as a follow-up. So, Steve, that was awesome. Thank you very much. I know it's in the middle of your afternoon. I know you've got a number of things going on there, but we look forward to having you back again soon.
Great. Everybody, happy holidays, and hope everybody has a great trading and investing year. And I'm signing off from San Diego.
All right. Sounds good. All right. Take it easy. And everyone, look for the recording. We look forward to having you on the next Top Shelf event. Thanks again for attending.